Good afternoon, ladies and gentlemen, and welcome to the Belvoir Group interim results for the interim period 30th of June 2021. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll send you an email when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and if you would give that to your kind attention, we'd be most grateful. And I'd now like to hand over to Dorian Gonzalez, CEO, and Louise George, CFO from Belvoir Group. Good afternoon.
Hi there, Mark, and thank you for the very kind introduction. Welcome everyone, and thank you in advance for listening to our H1 results presentation. The general format is that I'll sort of do the introductions. I'll explain the sort of mechanics of the business, who we are, what we do, and I'll run through a few of the sort of financial and operational highlights first of all. Then I'll pass across to Louise, the CFO. She'll run through several slides just to explain the financial position of the business, and then Louise will hand back to me, and I'll run through the markets that we're operating in, which are essentially mortgages, estate agency, and also property lettings. They're the three core markets we operate in. So I'll talk through a handful of slides that just explain the backdrop of what's been going on in the market over the last few months, including the stamp duty holiday, and then we'll do a wrap up at the end. I think that will take us sort of 20 to 30 minutes. We'll have plenty of time for Q&A. Louise will join me for the Q&A. So like all the best double acts, we'll sort of handle questions together. So please feel free as I'm talking, or as Louise is talking, just fire the questions across in chat, and then we'll deal with them, hopefully all of them, at the end of the presentation. So first of all, excuse me, brief introduction to Louise and to me, Dorian. I'm the CEO. I've been with the business for 16 years. This is now my 17th year. Key skills: franchising, people management, business development. I used to work for one of the large, before I joined the founders of Belvoir sort of 16 years ago, I used to work for one of the large corporate estate agency chains. We're highly skilled at franchising. So franchising really is at the heart of our business model. That's the real magic at the centre of our business. And what we've also done recently is expand into financial services, mortgages, but we've kept the sort of principles of franchising and self-employment right at the very heart of the mortgage business as well, and we'll explain that as the slide deck progresses. Louise joined me 7 years ago, and it's been a great 7 years. We sort of did a review for a magazine a few weeks ago on our achievements over the last sort of 7 years as a business, and when we've achieved so much during that period, including acquisitions, fairly aggressive growth over the period, and we've had 24 years of unbroken profit growth, which is incredible, and we'll sort of explain how we've achieved that through the presentation. We both have shares. Neither of us were founders of the business, so we're not majority shareholders or anything like that, but we certainly do have significant interest in the business, and the shares and share options are on the screen as you can see. So what are we and what do we do? So first and foremost, we are a property franchise group. So we trade with buyers, sellers of residential property. We trade with landlords and tenants. We look after properties on behalf of landlords, and we have a significant property lettings portfolio. We're also involved in financial services, i.e. mortgages, in partnership with a firm called Mortgage Advice Bureau, which is an AIM-listed business in its own right. And so what you can see on the screen here are the brands that we trade as. So when we first listed back in 2012, we floated at a share price of 75p. We floated as a dividend stock. Our revenue was recurring. It was underpinned by the revenue that's generated from managing properties. So when we listed, we only had Belvoir as a brand at that particular time. Belvoir was a lettings business, so primarily residential lettings, i.e. looking after properties on behalf of landlords. And then since we floated, we've acquired a number of businesses such as Newton Fallowell, Northwood, Lavelle and Humphreys, and we've partnered with other businesses such as Mortgage Advice Bureau and the Nottingham Building Society to deliver the growth that we're showing today. So across our core franchise business, we've got 467 offices nationwide. 366 of those are what you might sort of class as traditional estate agents. So these are franchisees operating in high street shops under the banner of either Belvoir, Newton Fallowell, Northwood, Lavelle or Humphreys. That's our core business. So we are a franchise business. Our franchisees are highly motivated to grow their business every single year. As I said earlier, we've had 24 years of unbroken profit growth. One of the main reasons for that is that we have franchisees at the heart of all of these offices that you can see on the screen, and every year they're looking to grow their business and explore new opportunities. Franchising, when it's done well, is a win-win situation for both the franchisor and the franchisee. So Belvoir was the first brand. That's primarily a residential lettings chain. Belvoir is very similar to Northwood. So we acquired the Northwood business in 2016. Again, it's 100% franchised, 91 offices. So if you put Northwood and Belvoir together in terms of office numbers, that's 250 offices. Most of our franchisees sit underneath either Belvoir or Northwood, and the revenue split within Belvoir and Northwood is 90% residential lettings, 10% estate agency. So, on one hand, while we've recently enjoyed a very active market, in part because of the stamp duty holiday, what I've always said is, we're a residential lettings business at the sort of heart. Estate agency to us is sort of, the icing on the cake. It's not the cake itself, and I'll illustrate that sort of later in the presentation. So Belvoir and Northwood, both very similar, both residential lettings chains. Newton Fallowell and Lavelle are our estate agency businesses. So Newton Fallowell was our first brand we acquired back in 2015. If you're in the East Midlands, you may have seen Newton Fallowell boards, so it operates in the East Midlands area, and it's very similar to Lavelle, which we acquired at the beginning of 2020. And again, Lavelle is a Lincolnshire-based agency group. It operates within the borders of Lincolnshire. I must admit that when we acquired Lavelle at the start of last year, we probably couldn't have picked a worse time to complete on an acquisition of 16 new offices. However, as the market sort of unfolded with stamp duty holidays, pent-up demand, etc. We're actually very pleased that we now have a larger estate agency footprint, and we've been capitalising on a very active market thanks to Lavelle and thanks to Newton Fallowell mainly. We acquired a business earlier this year called Nicholas Humphreys. That's very different again to Belvoir, Northwood, Newton Fallowell and Lavelle in that it's a student lettings business. So it's a franchise business mainly. 3 of the 20 offices are corporately owned, so we run them, we own them, we operate them. They're profitable, they're doing very well, and we do intend to do more with student lettings in the future via the Nicholas Humphreys brand. There's nothing stopping us from having a Humphreys office wherever there's a sort of university. The two remaining brands, so over the last 12 months, we've been working on a partnership with the Nottingham Building Society. I'll explain a little bit more about that on the next slide. I've got 1 or 2 pictures to show you. And we're now occupying, on a sort of co-occupying basis, 39 of the Nottingham Building Society branches. So we're taking window space, desk space, we're occupying their offices alongside the Building Society staff with a view to offering our property services to clients of the Nottingham Building Society. So that's a sort of co-op arrangement. Then finally, Mortgage Advice Bureau, separate brand, separate business in its own right. We decided 4 years ago that we wanted to expand our business by means of mortgages and mortgage advice. We decided to partner with Mortgage Advice Bureau because they're credible, they offer us access to lenders, they look after compliance, they look after training, and their brand is recognised and recognisable. And we've since grown our mortgage business to 242 advisors. These are individual mortgage advisors. They form part of our business. They're either employed by us or they're self-employed to us, and we choose to contract with Mortgage Advice Bureau to give us access to products, compliance, and all of the services that Mortgage Advice Bureau offer. We're very pleased with this partnership. We now represent about 15% of Mortgage Advice Bureau's entire mortgage advisor base, and that number continues to grow. So next slide, please, Louise. So first off, I'll come back to Mortgage Advice Bureau a little bit later on, just to explain the sort of mechanics of the mechanics and the financials of that. So a couple of examples for you. This is our growth strategy in action. So Nicholas Humphreys, a business we acquired 31st of March this year, 17 franchise, 3 corporate-owned offices, and we're still running those 3 corporates. The lettings to estate agency split 87 to 13. So again, this isn't subject to the vagaries of the property sales market. It's recurring revenue mainly on a ratio of 87-13. A portfolio of 6,250 managed properties, which brings our total across our whole business to 71,600 managed properties. Revenue of 2.8 million, operating property profit of 1 million in the year to March 20, and consideration was 4.1 million that we paid for out of cash. That is earnings accretive this year. Good business, entirely fits our sort of strategy, being a franchise business, and we know we can grow this business within the student lettings arena. Which, if you've got any experience of letting properties, you may know that student properties are just different to residential properties. Generally, their home has multiple occupancy. There are different licensing requirements. They can be very lucrative for landlords, more lucrative than a residential property in many cases, but it just takes a different level of expertise and systems to manage student properties versus a residential property. On the right-hand side of the slide, a couple of examples to illustrate the Nottingham Arrangement. So this strategic alliance started in 2020. So we first started with an alliance with the Nottingham, whereby we're occupying their offices to offer property services to their clients. Property services being property sales, estate agency, property lettings. We've since strengthened the alliance with Nottingham Mortgage Services in July this year, whereby we have acquired the Nottingham's mortgage business. It's called Nottingham Mortgage Services. We acquired that in July this year. It looks on the face of it to be quite a small acquisition. The devil's in the detail. It is a small profitable acquisition, but we are now writing all of the mortgages that are being arranged by the Nottingham. So we're their outsourced solution for writing mortgages within the Nottingham Building Society. I had a few questions back in July from investors who said, why would the Nottingham want to partner with you, and why would they want you to write their mortgages? The simple answer is that it's more profitable because of our scale. It's more profitable for us to provide mortgage services to the Nottingham than it is for the Nottingham to run their own mortgage division. There are one or two other benefits, such as when we first engaged with the Nottingham, they realised that our average case size was sort of much higher than their average case size, which again just contributes to the sort of profitability of the outsourcing model. One of the other clear benefits to this arrangement is that the Nottingham have around 50,000 savers in LISA accounts. Now, these people will be looking to buy properties and have mortgages in the coming years, and we will have exclusive access to these clients. This is really exciting for us, and it's forecast that their current number of 50,000 LISA savers will increase to 100,000 LISA savers over the next 2 years. And in Q4 of this year, the Nottingham is launching what they're calling a Beehive Money app for these savers to give them access, to help them manage their savings account and to give them access to mortgage advice via our service. That's been launched in Q4 of this year. It's quite difficult to sort of put numbers around that, as in how many mortgages we intend to write as a result of that, but you can see 50,000 people saving in these accounts, many of whom will want to use that money to buy a property. We can, of course, also offer them properties via our estate agency network. This is quite a unique arrangement in our sector, but we're very excited about it. Some of the other highlights in H1, I'm very pleased to say that revenue is up by 41% to 13.8 million. Pre-tax profit is up 51% to 4.8 million. MSF, which stands for Management Service Fee. If you're familiar with franchising, you'll know that franchisees pay the franchisor fees for providing the service and support that they do. That we shorten that to MSF, Management Service Fees. Management Service Fees, H1 versus H1, are up 26%. Later on in the presentation, we've got a graph that just shows our MSF growth. I think it's not since inception, but it's certainly since float. That's later in the slide deck, and it's a constant upward trajectory. We've also increased interim dividend from 3.4 pence to 4 pence per share. That's a 17.6% increase. Last year, during the sort of the start of the pandemic, we did suspend our dividend temporarily. It's the only time we've ever missed a beat on our dividend. We've always paid a dividend since listing back in 2012, but then we paid a catch-up dividend after exceeding our sort of pre-COVID expectations last year. So we actually had a very good year last year, as well as a good H1 this year. We've arranged 8,351 mortgages. It was 5,007 in the same period last year. That's a 67% increase. Earnings per share is up 36% to 9.9p. Interestingly, EPS over the last since 2015 is 165% up. House sales, you would expect us to have performed particularly well during a stamp duty holiday, and we have. We sold 6,166 properties in H1. That compares with 2,970 in H1 last year. It's not quite apples with apples, because in H1 last year, estate agents were effectively closed for 2 months of that period. And if you look at UK transaction volumes, H1 this year versus H1 last year, there have been about 103% more transactions across the UK. So we've outgrown the market in terms of transaction volumes. But as I say, H1 last year across the board meant that transaction numbers were actually down. Just wanted to highlight that. Financial advisors, we're now at 242 advisors. If you compare H1 last year with H1 this year, we finished H1 with 221 advisors. That's an increase of 47 over the last 12 months, which is a great result. So these advisors are joining us because they want access to our clients, essentially these transactions that are happening across our business. We're now at 242 advisors after the acquisition of Nottingham Mortgage Services in July. So we're now at 242. I think, Louise, that's probably enough of the operational sort of highlights for now. If you wouldn't mind talking through, run us through the financial review, please.
Certainly. Hello, everyone. So revenues up £4 million. Now, 800,000 of that increase came from the acquisition of Nicholas Humphreys that we acquired on the 31st of March this year. And we saw a £3.2 million increase arising from the underlying business. We saw revenue growth across all of our three markets. Lettings was up 21%, sales up 78%, and revenue from financial services up 51%. Our gross profit was up 33%, with the property division gross profit up 34% and financial services up 30%. Last year, we did receive COVID-19 grants from the government last year in the first half of 250,000, but they were repaid in the second half of the year, and obviously we haven't reclaimed anything in this year. Our profit before tax is up 51% to 4.8 million, and as you can see there, our tax charge looks unusually high compared to last year, and indeed the full year last year. This because it includes an extra charge of 345,000, which is the impact of the government announced that they would increase corporation tax to 25% from 2023, but that has an impact on our deferred tax balances. Those are going to unwind after March 2023, and we needed to reflect those in our accounts in this half. So that was an additional 345,000. It's not actually cash out the door. It is deferred tax. And then overall, that left our EPS up 36%. Sorry, 36% to 9.9 pence. Just looking at the results in a little bit more detail. As we said, the revenue was up 4 million. That was up 41%. Nicholas Humphreys was 8% of the revenue growth, with 33% of growth in the underlying business. When we drill down into the property division, the underlying property division was actually 19% up, and the financial services was up 51%. I'll come back to MSF on the next slide. Our income from corporate offices. So historically, we've held 2 corporate offices in Grantham, one trading under Newton Fallowell and one trading under Belvoir. When we acquired the Lavelle network in early 2020, that came with 5 corporate-owned offices, and that added 500,000 to revenue in the first half of last year. We've since franchised those out. So obviously, from a comparative point of view, we need to exclude that from last year's figures. And meanwhile, this year we've acquired Nicholas Humphreys, and that also we picked up 3 quite significant corporate-owned offices within that network, and that added 700,000 in the first half. When you take those movements out of the equation, then the revenue from the 2 original offices in Grantham was actually up 64% to 0.9 million. On our gross profit ratio, lettings sort of moved from 62% in the first half of last year to 56% in the first half of this year, with the kind of other side of that really being the movement on house sales. So that was 21% this year compared to 15% last year. And that really is a factor of what goes, the nature of the sales market. Sales was obviously badly hit by COVID last year, because not only were our offices all closed, they literally, really couldn't trade for at least 2 months. Whereas lettings, actually, a lot of the functions and revenue involved with lettings, carried on and had to carry on to support tenants and landlords. So, as always, lettings, very strong recurring revenue that carried on fairly unaffected by COVID, whereas sales was quite badly hit. Then you roll forward to this half of the year, lettings is still carrying on, doing quite nicely. But meanwhile, sales has obviously rocketed with the level of transactions in the first half. I suspect when we get past the distortions that we've seen over the last 2 years, plus our own distortions, if you like, added to this, because Lavelle we acquired last year was very much a sales estate agency network. Humphreys this year is a very much a lettings network. I think once the dust settles, we'll see lettings back up at 60%, if not over 60%. Just on the admin expenses, the impact of owning corporate offices does have quite an impact on the admin costs. So although admin costs were up 400,000, there was an increase of 600,000 associated with operating the Nicholas Humphreys offices, and that include 600,000 associated with the acquisition of Nicholas Humphreys, of which 100,000 was a one-off acquisition cost, and 500,000 was normal operating costs. But meanwhile, we saw a decrease of 400,000 from having franchised out the Lavelle corporate offices. In addition, we had an extra £100,000 of employers' national insurance contributions on the gain on share options that were exercised in June this year, mainly because the share price had moved so much between the end of at December 2020, the share price was £1.51, and I think by the end of June this year it was about £2.50, and so that had an impact on the national insurance on those options. Looking in more detail at the management service fees, it was up 26%. So management service fees are our key recurring revenue from franchisees, up £1 million. £100,000 was from the additional 5 Lavelle offices that were franchised in this half, and also the extra Nicholas Humphreys network of 17 franchised offices. But the other 900,000 is an increase from our underlying franchise network. When we look at it in terms of lettings and sales, lettings was up 13% to 4 million and sales was up 100% to 1.2 million. Oops, sorry, I've just realised I haven't pushed the slides forward. So hopefully you can all see that there, the increasing MSF graph, up £1 million, 13% and 100% on lettings and sales. Sorry about that. So just moving on to the balance sheet, the acquisition of Nicholas Humphreys actually added 4.1 million to our intangibles. Meanwhile, the last year in 2020, you can see that we had amounts held against assets held for resale. These are our Lavelle corporate offices, which were all franchised out by January 2021, so they've gone. Our period end cash was up 900,000 to 5.2 million. And it's worth noting that was having acquired Nicholas Humphreys for cash, and indeed having paid a dividend of 1.8 million in the first half, which included £500,000 of catch up against the final 2019 dividend. Our bank debt was down 900,000 to 9.2, and net debt of 4 was at 4 million, and that compares to 5.7 million at the end of the first half last year. So as you can see, it's a highly cash generative business. We saw 119% of operating profit converted to operating cash flow in the first half. It's that very cash generative nature of our business that has enabled us to acquire Nicholas Humphreys for cash. Indeed, if we look back a year, we acquired Lavelle for cash, so we've been able to do quite a number of deals, acquisitions in recent years from our cash reserves. We disposed of the final Lavelle corporate office, which was Grimsby Lettings, for 591,000, but that the franchisee was wholly funded by us through our franchise loan book and under our assisted acquisitions programme. You can see that the actual amount of franchisee loan repayments in the first half was up compared to last year, but that's because last year we gave our franchisees a capital repayment holiday during COVID to support them through that period. We'd also generated cash of 500,000, and that's from the issue of 1.1 million shares to satisfy share options that were exercised in the first half of the year. I've mentioned the final dividend. Clearly, that's a cash out in the first half of this year of 1.8 million. Actually, the current bank balance as of this morning, was 5.3 million, and that is worth noting that's having acquired in July Nottingham Mortgage Services for net cash of 600,000. So on that note, I shall pass back to Dorian.
Excellent, thanks, Louise. So what I'll do now on slide number 9, I'll sort of touch on the 3 markets that we're operating in. This usually generates a few questions as well, really, on what's going to happen next, what's happening with rents, what's happening with house price, etc. So first of all, obviously we are experiencing growth across all 3 of our markets. We've also increased our footprint, so we're now at 366 property offices with franchisees in each one. That's a 19% increase on the same period last year. I think earlier I sort of mentioned that we were up to 71,600 managed properties. That's an 11% increase. Financial advisors have covered and mortgages have covered, but you can see the sort of the growth in those sectors on the screen. On the right hand side is a summary of, really from an operational point of view, some of the movements that have happened within the business, and just wanted to draw your attention to one. For a long time I've said that that our revenue split, if you ignore financial services, I've said that our revenue split is normally sort of 80-20 in favour of recurring revenue, sort of property lettings. So thanks to the stamp duty holiday, my 80/20 now has shifted to 73/27, but I more than suspect it will shift back to 80/20 in the coming months. So just to give you an idea of the markets and what's happening in each market that we're operating in. So on page number 13, please, Louise. That's it. What's happening with rents, first of all? So we've got the blue line, which is UK average rent on new tenancies. So that's the average rent on new tenancies across all properties. This is England based. Then you've got UK rental index on new tenancies. So really, and I'll explain the differences. So I mean, first off, June 2021 UK annual rental index of 1.2%. What that means is that's rental inflation across existing tenancies. So some tenants stay in properties for 3, 4, 5, 6 years. During that period, rents do go up. Rents they can come down in some areas, but rents generally will go up. And according to ONS, rents across existing tenancies are running at 1.2% year-on-year increase. Now, ONS goes to great lengths to try and work that out, because it's notoriously difficult to work out what's happening with rents across existing tenancies, because they're just simply not reported anywhere. So proactively, ONS, by means of sort of valuation officers, have to do a lot of work to try and establish what's happening with rents on existing tenancies. So up until June, 1.2%. But then another measure is what's happening with rents when tenancies are created. So new tenancies, and what's happening at the sort of front end is that rents in the year to June 2021, it's actually higher than this now, but in the year to 2020 to June, new tenancies up 5.9%, so rents up 5.9% and 8% if you exclude London. If you were on this group in April, I said at that time that rents were going up everywhere apart from in London. That's now changed. Rents are just going up everywhere. In some areas of the UK, we're seeing double-digit rental inflation on new tenancies. And just to give you an idea of where that is, so in the southwest, rents are up year-on-year, new tenancies 11.9%, the West Midlands 6.9%, East Midlands 10.7%, so double-digit growth. So the southwest is seeing the most aggressive rental increases, closely followed by the East Midlands, where we operate, or where a lot of our offices are. London 3.6%, rents have increased by year-on-year. Interestingly, the average rent now in the Greater London area on new tenancies being created is £1,700 a month. Across our existing portfolio, our average rent is more like £850. Main reason for that is that most of our revenue is still derived from outside of the M25, so 93% of our revenue is outside of London. So bottom line is that huge demand for rental properties, so demand is outstripping supply. Where is this demand coming from? Well, there's a good side and a bad side with property prices going up. The good side is people are benefiting if you're a homeowner. The downside is that house price increases lock out first-time buyers or another tranche of first-time buyers, meaning that their only option is to join the private rented sector. So we're seeing demand from that side. We're also seeing the race for space, so tenants looking for more space, bigger gardens, better working environments, and maybe more space to work from home still, therefore changes of working patterns. So lots of reasons why demand is very high. I think what we're also seeing is, I think it's pretty clear that government have been discouraging landlords over the last sort of 5 years. Now, the private rented sector has remained incredibly robust, and it's remained the same size for the last 4 years. So although government has been discouraging landlords from joining the sector by means of increase on stamp duty, Section 24 mortgage interest tax relief being phased out, a number of measures have discouraged landlords from entering the sector. The real reason for that is that government hasn't been looking to do away with landlords, because where on earth would 13 million tenants live if that was the case? But government was just looking to take some of the fizz out of buy-to-let and some of the competitiveness away from landlords to drive home ownership, and that's been successful. So over the last 5 years, the numbers of properties under owner occupation has increased by 1 million over the last 5 years. I appreciate this isn't in the slides, but it's just me talking. So owner occupation has increased over the last 5 years by around 1 million properties. So my point being, what I actually think we're seeing now with rents growing quite aggressively, it is probably overdue. You know, if you discourage landlords, there'll be fewer properties available to rent, and when those properties do come up for rent, the rents are going to be higher. That's exactly what we're seeing happening in the rental sector. Our lettings business has performed really well in H1, so it's 21% up in terms of revenue. 8% of that is underlying organic growth. 13% came from the acquisition of the Humphreys business. So part acquisition, part organic. So onto the residential sales side of the business. So this has been hugely covered by the media. So we've had the stamp duty holiday that it comes to an end at the end of this month, and you know, what's been great is that Rishi Sunak extended the stamp duty holiday. So we were at the start of the year, we were expecting the stamp duty holiday to finish at the end of March. We were expecting a huge spike in transactions and an immediate cliff edge thereafter, which, you know, I've been through stamp duty holidays in the past, and that's exactly what you see. So Rishi Sunak decided to do away with the cliff edge by extending the stamp duty holiday and tapering stamp duty back in. So as of you know, the 1st of next month, stamp duty returns to normal. And what you can see on this graph is, you know, you can see the number of transactions. It dipped sort of May, June last year when estate agents were closed, and then you can see transaction numbers start to climb. And what's actually happened in the broad brush sense is that in a normal year, so typical year compared to the last 2, 3, 4 years in our sector, you would normally see 1.2 million transactions per year, there or thereabouts. So in the first half of last year, transaction numbers fell to 400,000, when you would expect that to be 600,000 if annualized, it's 1.2 million. So a number of transactions disappeared from the first half of last year because agents were closed, and that those transactions fell into the second half of the year. And what I said back in April was, I said I suspect in 2021 that we'll see about 1.6 million transactions, i.e. 400,000 transactions more than in a normal year, and that's exactly where we are. So we will, by the looks of things, transactions will be around 1.6 million at the end of this year, so 400,000 more than in a normal sort of normal year. What happens next is that you know, unless one of the fundamentals changes in the sector, i.e. access to cheap lending, you know, if that disappears, then the market will change, no doubt, but there certainly aren't any signs of that. It looks like we're heading for a soft landing back to normal levels of property transactions. One thing I would say is that our pipeline, just to demonstrate that the demand in the market is not just being driven by stamp duty. First off, property prices have increased during the stamp duty holiday, therefore the saving is kind of no longer the saving. And then on top of that, our current pipelines in estate agency and financial services, our pipelines are 70% larger than they were in August 2019. And bear in mind, the stamp duty holiday is about to come to an end. So my point being is that there's still high demand for moving house, regardless of whether there's a stamp duty holiday or not. So we're very confident we will achieve market expectations this year. We can see our pipelines, we can see what's going to happen in Q4 this year, and as I say, our pipelines remain very strong, even at the point where the stamp duty holiday is about to end. So onto mortgage approvals. You'll see that the red line is very similar to the previous slide. So mortgage approvals have kind of followed estate agency because of the sheer volume really in the sector over the last 12 months. The blue line is remortgage, and the dark line is buy to let. So you can see buy to let has been very stable for the last 5 years. So same numbers, or very similar numbers, and remortgages again pretty level. What we think will happen in Q4 is that because mortgage lending has become so competitive, and I looked at some of the mortgage deals available yesterday, and there are deals available, 5-year deals, a number of them at sort of sub 1% in terms of rates. It's very, very competitive. We think that will drive remortgage lending in Q4 of this year, which obviously with 240 mortgage advisors, we're best placed to capitalise on. So a sort of summary, why invest in Belvoir? I appreciate that I've seen some of the messages coming through the chat messages and questions, and I appreciate that some of you have been really loyal shareholders. So a quick reminder on why invest. We've proven that we can acquire additional brands. We're now running 6 brands. By means of having an entrepreneurial franchisee at the heart of each business, just means that we can continue to grow. We've got a driver within the business, and last year's performance through COVID shows that whatever you throw at a franchise business in terms of a change in market, franchisees generally perform extremely well because they've got 100% skin in the game. We've had 24 years of unbroken profit growth, as I mentioned earlier, and there are 1 or 2 questions around that, so we'll come back to that. But EPS in the 4 years to 2020 had increased by 165%. We've got a great management team, and I appreciate lots of businesses say this, but we've got 12 years average length of service across my management team. I've got 15 very strong managers and MDs. Michelle Brooke is still on board, who grew the Brooke business. She runs our mortgage division. Mark Newton is still on board, who grew Newton Fallowell. We've got one of the original directors of Northwood, Phil G, who runs Northwood as the managing director. We've got the right people in the right places, and they've got huge experience. One of my personal goals during sort of lockdown 1 last year was to make sure we emerged from the sort of COVID crisis with our management team entirely intact, and we have. So we haven't lost any of our management team during that period. High degree of recurring revenue, which I appreciate is really important to you. 56% of our gross profit comes from recurring lettings, and as Louise mentioned earlier, that figure will trip up as estate agency revenue adjusts. Diversification. So when we floated back in 2012, we did nothing else apart from residential lettings, nothing at all. And you've seen us diversify over the last 5 years into estate agency and into financial services, and we've got plans to diversify further. There's nothing stopping us as a franchise business. We're very skilled at franchising. There's nothing stopping us from running other franchise businesses that offer complementary property related services, but that may not be property in itself. There's nothing stopping us from doing that. We remain very acquisitive. We think that at the start of next year, there'll be much more acquisition opportunities coming to market. We just think that because a lot of agents and chains who may have been thinking of selling during the COVID crisis couldn't because of the crisis. Agents have then emerged into a very, very active housing market. So they've been making hay while the sun shines. So now the market has sort of peaked on the estate agency side. We feel that it'll throw up what we're very good at doing, and that's acquiring good quality businesses with recurring revenue. We feel there'll be more opportunities to come in the next few months. A reminder on the number of acquisitions. So since 2015, we've acquired 8 corporate acquisitions, and we've helped our franchisees to acquire 105 of their direct competitors, and we will continue in the same vein. So we're very excited about the future. The outlook going forward. So we are confident that we'll achieve market expectations. We've got strong trading across all 3 markets. Our pipelines are stronger than we expected them to be at this point in the year. And as I say, they're 70% up on August 2019. We've got lots to do on the mortgage side. We in terms of the revenue that we're generating from mortgages, 90% of the revenue isn't coming from our franchise network. So we're just getting a 10% contribution at the minute from franchisees in terms of mortgage business transacted. That's because it's new, and that's because they've been very busy dealing with a very active property market. So we've got lots more opportunities to further develop our mortgage business, even though it's gone very well over the last 12 months. And yeah, so we remain very acquisitive. We're out there looking at, looking for suitable businesses to join our stable of brands. So I think that kind of brings me to the end of the sort of fixed presentation. Shall we, Louise? Are you there? That's my first
Yes,
question.
I am here. Yeah, I think
Right.
not in
So-
any particular order, but this one might be worth picking up. Andrew has asked, and I think to some extent you've answered this, but just to cover it, Andrew's asked about concern about from investors that we might be at the top of the cycle, and how this might unwind at the end of the stamp duty holiday, and to what extent, we feel we're going to see a more normalised business, which I think just mostly you covered, but I don't know whether you want to wrap that an answer up into a few words.
Yeah, I mean, so we work really hard to continue growing our profit and growing the business, and I think we've had to put up with and adjust for over the last 18 months of these distortions in the market. So in H1 last year we had 200,000 transactions across the UK just disappeared from the market. They then happened in the second half of last year, so that was a distortion. Then we had the difficulties, obviously, around COVID, and then we had the pleasant difficulties of dealing with the stamp duty sort of holiday, which again has just distorted the revenue streams more than anything. So I think, and we've certainly capitalised on it where we can. I think really we're almost due to return to previous transaction numbers on the estate agency side. We are seeing more activity from landlords, which I think again is overdue. Landlords will be seeing that there is a real shortage of rental stock across the whole of the UK, and if the demand's there, landlords will satisfy that demand. So I think we'll see more activity on the sort of buy-to-let side, more remortgaging activity towards the end of the year. Hopefully, because of the distortions, we'll still be able to say, we've had 24 or 25 years of uninterrupted profit growth. It depends whether you think we're acquisitive. It depends whether you think, we'll make any deals happen or not. I think that's yet to be seen, really, Louise. That's the bottom line.
Yeah, definitely. And I think one thing we do know about our franchise network, and when I talk about our franchise network, I think actually the model on the financial services side, which is all, independent, self-employed and self-motivated financial advisors, these guys are quite keen to find ways in which if there is any shortfall on revenue arising from sales or mortgages related to sales, we've always found historically that the guys are very focused on how to make up that revenue and look at other revenue streams. So that gives us some confidence that, to the extent that sales normalizes, they'll work hard to make up any shortfall. I think that the issue with the 24 years unbroken profit growth is coming to a couple of questions. One asking whether we'll be a victim of our own success. It does make each year another challenge, doesn't it? But we do keep moving forward. But the other one was more around. Let me just back up again. Perhaps it's gone. But yes, I think on the unbroken profit growth, I think actually one of the other questions alluded to the FinCap note, which does suggest that we do lose that unbroken profit growth next year. I think that the note is written around what we know at the moment, and we do know that the sales market will go to a more normal level. But we also know that as a management team, we're very committed to keep growing the business. So what can't be in the note is what steps we might take over the next 6 months to drive further revenue and profit.
Just on that one, Louise, I think there's another question as well. I mean, this one was from one of the last questions was from John, so thanks for that, John. And I've got one from David P. So it says, please give your personal thoughts on the nonsensical vagaries of the share price in the past few days, particularly given the great performance of the business. What could be driving such sentiment, in your opinion? It's an interesting one, isn't it? And I think when I've been thinking about this, presumably it's because people think that estate agency transactions due to the stamp duty holiday will return back to normal. But then on the flip side of that, when the market's normal, our business has been performing really well. So to me, it actually doesn't make any sense, and I agree with that, David. I think the other part of it is that maybe people just don't understand that estate agency to us is only a relatively small part of our business. Therefore, we haven't had the huge upside from estate agency. We have had an upside, but it's not huge, and it's good, but it's not huge. But likewise, we wouldn't suffer the huge fall if the state agency does sort of slow down. So to us, the stamp duty holiday and the activity has been very much the icing on the cake. It hasn't been the cake itself, and every single part of our business is growing. And FS was growing long before the stamp duty holiday was sort of announced. Our strategy is rock solid. I think, if anything, one thing that the market has, one thing that's happened in the market that hasn't been very helpful is that it's sort of discouraged agents and chains from selling over the last 12 months because they've sort of sat back and made the most of a very active market, when I would have preferred them to be knocking on our door asking if we want to buy them. So it sort of starved us of a few opportunities, if that's the right description. But yeah, I couldn't really understand it either, David. The business is rock solid, performance is great. We've already said that we're confident of achieving expectations for the full year, and our strategy remains unchanged. We're going to keep growing each part of the business similar to as we've been growing in previous years.
There was a question,
answers David's question as well.
Yeah. There's a question from Dennis there about the FinCap forecast, suggesting that earnings per share of 19.8% this year will fall to 18.8 pence in 2022. And I think that partly is reflecting the fact that FinCap are forecasting our reported earnings to be lower next year, for valid reasons in terms of this, the sales market, but also the EPS is always calculated on a weighted average number of shares. So we had quite a tranche of shares issued in June this year, which will obviously, on a weighted basis, will only have an impact on half the year. So I think part of that change in the EPS is due to an increased number of shares in the market as well. But as we said, we will be working very hard to see our reported earnings not go backwards.
Louise, Hank's put forward
a couple of questions. Hank's asked a couple on the gross profit. So if I pick up on those ones. So when we look at our gross margin, just bear in mind that the cost of sales is all on the financial services side. Do you want to run
through the question as well?
The question is asking for an explanation why the gross profit margin at financial services went down to 24% in the first half of this year compared to 28% last year, and what can be assumed about the run rate of the gross profit going forwards. And as I say, the gross, if you look at the property side doesn't have a cost of sale, so that's sort of that's not affected. So this is where this is all about the pay away to advisors. The cost of sale is all about the pay away to advisors and pay away to introducers. And what we saw in the this year is that we've had a shift towards more more independent business partners, as we call them. Whereas on the property side, it's franchisees. On the financial services side, we call them business partners. But more independent business partners who are operating within our financial services network. And they're a bit like the franchisees. They operate very independently. They're very light touch. We support them centrally. So whilst we tend to have to give them a better rate, and that's why it's affected the margin. But if you then look at the operating margin has actually increased over this first half from 33%, 32.9% in the first half of last year to 34.6% this year. So what we see is we're able to increase the size of the advisor network, but without increasing the overhead base proportionately. So that has contributed to that improvement in operating margin. And the other thing that Henk asked was about the full year outlook. What could the full year gross profit be in 2021? The FinCap note is actually forecasting it to be about 17.8. So that is literally an equal split between the first and the second half. Another 8.95 million in the second half. Hopefully that will cover everything that Henk wanted to know.
Brilliant. And we've got a couple from John, if that's all right. They're the ones labelled Manusi, I think. So the one is: do we expect second half 21 EBITDA and PBT to be higher as on the one hand, sales market will probably be lower, but this will get offset by growth from M&A. I mean, it's difficult. I mean, we
well, I think one factor comes in there, the way we plan our year. So not unlike many other businesses, we have management targets and bonuses, and they tend to crystallize obviously in December when we know what the results have been. So in terms of the cost base can tend to be slightly higher in the second half of the year in any case. And in addition to that, when you look at the FinCat numbers, you can see they're pared back on the sales revenue. So we won't see perhaps as much EBITDA in the second half when you compare it to the first half.
Yeah, that's a good one.
But
as far as
interestingly, on the revenue side, the way in which FinCap has scaled back the property sales, that's compensated by increases on the financial services side. So as I said earlier, the gross profit is pretty much 50-50 between the two halves. It's just it's likely that the cost base in the second half will be higher.
Yeah, thanks, Louise. That was really good. I think John also asked about sort of what's the M&A pipeline looking like at the minute, and that's one thing that we can't sort of say. I mean, just to reassure you, John, you followed our story for probably the last 5 years, I think, if memory serves, and you've seen that we are acquisitive every single year. This year we have completed on 2 acquisitions already. I think we're sort of ramping up our acquisition searching and just widening the scope of the type of acquisition that we're looking for, simply because we can see that the market's going to start to return to normal. We believe that's going to throw up acquisition opportunities, and we don't just want to be ready for those. We're out there sort of knocking on doors, actively looking for those opportunities. If that gives you some reassurance. Interesting, John, this might make you smile, but a fund manager said to me a while ago, he said, Dorian, on acquisitions, why don't you just have a year off? And I said, well, it just doesn't work that way, because we are opportunistic, and if we find a good opportunity, they're never going to wait for 6 or 12 months for us to have a year off. So no, we remain as acquisitive as we always have been. And then I've got another question here. I was
just going to say, on that M&A side of it, it's also worth mentioning assisted acquisitions, because that's the other side of our acquisition model, if you like. And we did, I think it would be fair to say, because of COVID, and then that's a distraction, and then people have obviously, estate agents have obviously had a good year this year. We saw fewer opportunities come along, but that's beginning to flow back now, isn't it, Dorian?
It is. And we've got about 100 franchisees who are actively seeking an acquisition, and it's just trying to partner the demand for acquisitions with the opportunities that we've got. Different to other franchise models, we have a full-time acquisitions team in-house. So we've got 4 members of staff who work in our acquisitions team, headed up by a great guy, Martin, who's been with me for a number of years, very experienced acquisition guy. And yeah, we're out there canvassing and sort of processing leads all the time. We do have franchisee acquisitions in the pipeline. We always have. So we've always got a pretty decent pipeline of franchisee acquisitions. I think we're doing quite well with the questions, Louise. I've got another one on block management. It's sort of a split question. So Scott's asking, in light of can we share what was learned from the pilot scheme of either block management or Beehive? I may not have explained that very well, Scott. So they are 2 different things. So firstly, the Beehive Money app is something that Mortgage Advice Bureau.
I've got a feeling, Dorian, this is a different Beehive that is to do with block management. It's confused me in the past.
Do you know which Beehive this one is?
I think this is something to do with HML and the block management, as opposed to.
Understand. Got it. Right. So this is actually a squarely sort of block management question. So
I think so.
I think the starting point, Scott, is to say, what do we want to do with blocks long term? So block management is difficult. Is different to normal residential lettings. It requires a number of things. It requires accounts skill, knowledge of block management, higher level of compliance, but it also needs boots on the ground for general property maintenance and management. Some of our franchisees have been involved in block, for a number of years in a very small way. So we're doing a few things. So firstly, we've partnered with a firm who is now providing our franchisees with back office functions to help them with block management. So this is the sort of the arrangement that you're referring to, Scott. This arrangement really helps franchisees to concentrate on the areas of block management that they're good at, without having to worry about the areas that they're not so good at. So it's kind of a back office arrangement on one hand, but then it's a training and systems arrangement on the other hand. So, I mean, part of your question was, will all franchisees want to get on board with the idea? No, not all of them will want involvement with block management. We suspect it'll be a quarter of the network, I suspect, will want to get involved in block, and longer term, although we're outsourcing those functions now, I'm very keen to acquire a block management business at some point when we find the right opportunity. So that's kind of where I think it will go, over the next few years. And there is a natural tie-in between between property management and block management, and yeah, that's where we are with it.
It might be an opportune time for me just to jump in, Dorian Louise. Obviously,
Sure.
thank you so much to all those investors that have submitted questions, and thank you for responding. Perhaps we're coming up to the hour. I don't think there are any further questions, and of course, if there are any, we'll make those available to you after the meeting. But perhaps before I redirect investors to provide you feedback, which I know is important to you both, I could ask you just for a few closing comments.
Yeah, that was great actually, and that's spot on time, which is incredible. So, no, Mark, thank you for hosting it. I thought it's a really professional platform, and a huge thank you to the attendees for listening to us and giving us an hour of their time.
That's great.
Yes, thank you very much, everyone. Thank you, Mark.
That's great. Dorian Louise, thank you very much once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Belvoir, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.